It's been hectic, to say the least, since Standard & Poor's downgraded U.S. Treasury debt as well as the debt of government housing giants Fannie Mae and Freddie Mac. The Dow has alternately plummeted and soared like an out-of-control elevator, leaving frightened investors wondering what's next. So this is the time to maintain your composure, even if everyone else is losing theirs. Let's look at what the downgrade and its aftermath might mean in three key areas: your investments, your cash reserves, and interest rates. Let's start with your investments. How do you participate in the long-term growth stocks offer without getting hammered too badly when stocks suffer their inevitable periodic declines? You have two choices. One is to try to outguess the market. That is, capitalize on stocks when they're doing well and then move into bonds, cash, gold, or whatever to avoid downturns and then get back in for the rally. Good luck with getting all those moves right. The other, and to my mind more sensible way to go, is to create a mix of stocks and bonds that gives you a shot at solid returns but also offers at least some protection. The longer your time horizon, that is, the longer you have until you need the money, the more you can afford to devote to stocks and ride out short-term downturns. For advice on how to set an asset allocation to make sense for you, you can check out our Fix Your Mix calculator. To get an idea of how different mixes of stocks, bonds, and cash have fared in 8 previous major downturns, you can check out this diversification and bear markets calculator. By plugging in different blends of stocks, bonds, and cash and seeing what sort of losses they incurred, you can get a better feel for what allocation is right for you. Now let's talk about your cash reserves. By cash reserves, I mean money you can't afford to put at risk. This would include an emergency fund to pay unanticipated expenses or a stash to provide 3 to 6 months worth of living expenses should you get laid off. And if you're retired, your cash reserves should include enough to fund 1 to 2 years worth of living expenses. So that pretty much leaves 2 places to put your must-have cash: a money market fund or an FDIC-insured account. Finally, interest rates. One of the big concerns when S&P announced its downgrades was that the interest rates on U.S. government debts would rise, pushing up other rates with it. For now, at least, that doesn't appear to be happening for several reasons. One is that ultimately, bond investors determine interest rates, not a bunch of guys in ties on S&P's sovereign debt committee. And so far, bond investors still consider Treasury debt a safe haven, even if it's now rated AA rather than AAA. Rates have also remained low because the economy is so weak, which means that if you're looking to cash in on low home prices, now could actually be an excellent time to shop for a mortgage. The same goes if you're considering refinancing an existing home loan or even taking out a home equity line of credit. I think that we should all be prepared for more chills and spills in the market. But whatever lies ahead, you'll do much better if you approach it with an air of equanimity and, if possible, even Zen-like calm. And most of all, you want to avoid getting sucked into the frenzy.